Hey guys, this is KYT, and we're going to do another video for my Investing 101 playlist. For this one, we are going to focus on why beginners are often told to focus on getting lower fees. You often hear this a lot. Mutual funds are too expensive. Their fees are 2% versus XEQT that's 0.2. So avoid mutual funds at all costs. But what I've realized after talking to many beginners is that just focusing on fees is incomplete. It leaves them wondering, like, what if I'm paying more fees, but my overall return is better? Like, what if I'm making 20%, I'm paying more fees, but the other fund is making 15%? It would seem like the fees are worth it. I've seen this question asked a lot, and even recently in one of the Facebook groups I'm in, someone's talking about how their mind has been opened because they've discovered the importance of low fees, and that they're basically implying that being in mutual funds is too expensive, and they regret being in mutual funds for so long because they've been paying that extra percentage for that period of time. And someone says, not really sure I completely agree. Yes, 99% of funds are crap, but there are a few I hold that I like that have good returns. Someone says, at what cost and fees? And the answer is, what does it matter? Returns on funds are net of fees. So if you have a fund returning a 20% return and an ETF earning 20%, it's the same thing. When we think about these mutual funds doing really well, we think about them probably being headed by a portfolio manager that knows what they're doing. They're making good gains because they're doing the proper research. We assume it makes sense to assume that better performance is due to more skill. So then it's natural to think to get better returns, just get a more skilled manager. But the problem here's a key problem, is that it's hard to identify which managers are skilled, and past returns aren't necessarily a good way to determine that. That's due to the fact that there are so many funds out there. According to the Investment Company Institute, as I scroll down here, by the end of 2023, there were 68,851 funds, regulated open-end funds. And here's the thing. If you have that many funds and you imagine each fund, like replace it with not a portfolio manager, but a monkey that picks random stocks, what's going to happen after a set period of time is that some monkeys will do really well, some will break even, close to break even, and some will do really poorly. So it's really hard to tell if it's skill or luck. ARK is an example of how it could be really hard to tell. In their first 2 years, Cathie, very famous investor, started really well, right? The first 2 years, 35%, 152%. So most people heard about her here and thought she was really skilled because she was crushing it. But then, minus 23%, minus 67%. And despite having a good year in 2023, most people are in the negatives because they invested somewhere here, assuming that she was skilled. Now, her poor performance doesn't mean she's not skilled either. The key takeaway is that it's really hard to tell. In his excellent video, Chasing Top Fund Managers, Ben Felix goes over quite a few famous investors that were known or touted to be geniuses because of their great performance. But all the ones that he covers eventually got crushed by the market. Here, I'm just showing more data from spglobal.com that really reinforces how hard it is to beat the market or beat a given index. Here in the United States, 88% of funds underperform the S&P 500. For the Canadian index, the S&P and TSX composite, in 10 years, within the last 10 years, 97% of funds underperform the S&P and TSX composite. But here's something that you might be thinking, because in Canada, there's at least 3.37% that did outperform. And in the US, there were roughly 12%. And it's all about finding what these funds are in advance. And we had talked about simple results. Short-term results won't tell you much. But what if long-term results? What if we can analyze funds and see that, pick funds that have a sustained length of a good track record? Maybe that would help us outperform. And unsurprisingly, spglobal.com has this type of research done already, and they call it their Spiva persistent scorecard, which they do, I think, every year or every 6 months. And the takeaway, and it's very similar, their scorecards. A lot of these research that shows active management is hard has the same conclusion. And here it goes. Among top quartile funds within all reported active domestic equity categories as of December 2019, not a single fund remained in the top quartile over the next 4 years. So those that did really well, they didn't see any of them doing really well again in the next 4 years. Exhibit 1 illustrates that the percentage of top half actively managed domestic equity funds consistently remaining in the top half over a 5-year period, see report 2, was less than a random distribution would suggest, evidence that active performance when it occurs tends to be the result of luck rather than genuine skill. So let me break down this graph here. It shows that all the top half funds, if you just randomize their performance, they all like pick random stocks over the next 5 years, you would still expect 6.3% to be in the top half, even if they just pick randomly. The fact that you see less percent, this in every category and every type of fund where it's multi-cap, domestic, large cap, or small cap, suggests that they're doing worse than just random selection, which means, of course, that outperforming the market is really hard, and to sustain that performance is really hard, and to pick which fund is going to do well in the next 5 years is really hard. So I'll end this video by briefly talking about why it's so hard to beat the market, even if you're a genius. It's because it's a market and super smart people, lots of super smart people are competing at each other in real time every second that the market is active. I think it's common to think that all you have to do is pick good companies, they perform well, and you're going to do well. That's not how the market works. So I'm just going to do a very simplified example. Like here, McDonald's is worth 254 USD per share, but that's because it's consisted of people that are willing to bid roughly 253 and people that are willing to sell shares at 254, roughly. You're going to see this in your brokerage account, whether it's Wealthsimple, Questrade, whatever. You're going to actually see these bid and ask and the size and the number of people on each side. But what can happen is, let's say, these earnings reports that you might hear about, or these news, or like the CEO changes, or a CEO gets fired, there's a big scandal, or the earnings report are really good. They made a lot of money, a lot more money than people thought in the last quarter. And then the value of the company changes, and everyone who's participating in the market might want to buy based on what they believe the new price to be, based on the more recent news, and news is happening all the time. So let's say you're an expert, some news comes out, you read it, and you think McDonald's should be worth roughly, I don't know, 275, even 300. So you rush to buy it. The thing is, because you're competing with the entire world, either these guys no longer want to sell at this price at 254 because they also agree, or there's a lot of people that agree with you that's worth a lot more and they buy up all these shares. And so none of them are going to be selling at 254. They're all gone. And this price will keep going up because you're only going to get sellers that will sell at a higher price. And which links to the market efficiency hypothesis. One of the most important concepts in investing is that people are competing so fast, they're injecting that information so fast, the price moves really quick that it's too fast for a lot of people to take advantage of the news. And I hope that gives a little idea of why it's hard to outperform. It's you against all the funds out there. And so that's why low-cost ETFs like XEQT is recommended, because instead of trying to pick which fund is going to do well when it's a highly competitive market and you're unlikely to know which fund has a skilled manager and which one will be able to have persistent outperformance, you go with the globally diversified strategy, pay a lower fee, and do better than most managers. That's it. With that said, I'll see you in the next one.